Student loans have become a defining feature of higher education in America, helping millions access college, but also saddling many with decades of debt. With over $1.07 trillion owed by 43 million borrowers, understanding how student loans work, from types and repayment options to the costs and risks, is more important than ever. Whether you're a student, parent, or policymaker, knowing the truth about student loans can help you make smarter financial decisions and navigate this complex system with confidence. Let's uncover what you really need to know about student loans in America today. Today, we will talk about the truth about student loans in America, what you need to know. So, before we start, make sure to hit the like button and subscribe to my channel. Student loans have become an essential, yet deeply complex and controversial component of higher education in the United States. While these loans have enabled millions of Americans to pursue college degrees and professional aspirations, they have also led to unprecedented levels of personal debt and financial anxiety. As of 2025, student loan debt in the U.S. exceeds $1.7 trillion, affecting over 43 million borrowers. The system is entangled with federal and private lenders, varying repayment plans, fluctuating interest rates, and ongoing political debate about reform or forgiveness. Understanding the full scope of student loans, how they work, what they offer, and the risks they pose is critical not just for students, but for families, policymakers, and the economy at large. This article provides a deep dive into the structure, history, benefits, pitfalls, and current landscape of student loans in America. 1. A historical overview of student loans in America. The federal student loan system in the U.S. began in 1958 with the National Defense Education Act, which aimed to boost higher education during the Cold War. It expanded significantly with the Higher Education Act of 1965, which established the foundation of today's federal student loan programs. Over the decades, student loans became more accessible, especially during the 1990s and early 2000s, as tuition costs soared. As public funding for colleges declined, institutions increasingly shifted costs to students, and borrowing became a necessity rather than a choice. The introduction of direct loans in the 1990s gave the Department of Education control over most federal lending. Today, the federal government originates the majority of student loans, while private lenders fill the gap for those who exceed federal borrowing limits or seek different terms. 2. Types of student loans: federal versus private. Student loans fall into two primary categories: federal loans and private loans. Federal loans are issued by the U.S. Department of Education and are generally preferred due to fixed interest rates, flexible repayment options, and access to forgiveness and deferment programs. There are four main types of federal loans. Direct subsidized loans, for undergraduate students with financial need. Interest is paid by the government while in school and during deferment. Direct unsubsidized loans, available to both undergraduate and graduate students regardless of financial need. Interest accrues immediately. Direct PLUS loans, for graduate students and parents of undergrads, requires a credit check and has higher interest rates. Direct consolidation loans allow borrowers to combine multiple federal loans into one, simplifying repayment. Private student loans, by contrast, are offered by banks, credit unions, and other financial institutions. These loans typically require good credit or a co-signer and often come with variable interest rates and fewer borrower protections. They are not eligible for federal forgiveness or income-driven repayment, IDR plans, and deferment options are limited. 3. Understanding interest rates and capitalization. Interest on student loans can significantly affect the total amount you owe. Federal loan interest rates are set annually by Congress and are fixed for the life of the loan. As of the 2024 to 2025 academic year, undergraduate federal loans carry an interest rate around 5.5%, while graduate PLUS loans may exceed 8%. For unsubsidized loans, interest accrues while the student is in school, during grace periods and deferment. If unpaid, this interest is often capitalized, added to the loan principal, meaning future interest accrues on a larger balance. This compounding effect can lead to substantially higher repayment amounts than originally borrowed. Private loans may have even higher rates and lack protections to shield against interest accrual during hardship. 4. Loan limits and borrowing caps. Federal loans come with annual and aggregate borrowing limits to prevent overborrowing. For dependent undergraduate students, the maximum ranges from $5,500 to $7,500 per year, with a lifetime cap of $31,000. Independent students and graduate students have higher limits. Graduate students may borrow up to $20,500 per year in unsubsidized loans, with total limits reaching $138,500, including undergraduate borrowing. PLES loans do not have a strict borrowing cap but are limited to the cost of attendance minus other aid. Private loans, on the other hand, may allow borrowing up to the full cost of attendance, but usually depend on creditworthiness and require a cosigner for many students. 5. The real cost of college and loan dependency, as tuition, housing, books, and fees have outpaced inflation. More students have turned to loans to fill the financial gap. According to the College Board, the average cost of attendance for a public four-year in-state university is now over $27,000 per year, while private colleges average over $55,000 per year. Even with grants and scholarships, most students cannot afford college without borrowing. This dependence on loans has created a cycle of debt that follows graduates for years, sometimes decades, after completing their education. While a degree often increases lifetime earnings, the initial burden of debt can delay milestones like buying a home, saving for retirement, or starting a business. 6. Repayment options and plans. One of the advantages of federal student loans is access to flexible repayment plans. Standard repayment involves fixed payments over 10 years, but many borrowers opt for income-driven repayment (IDR) plans, which adjust monthly payments based on income and family size. These include Revised Pay as You Earn (REPAYE) / Saving on a Valuable Education (SAV) plan, Pay as You Earn (PAYE), Income-Based Repayment (IBR), Income Contingent Repayment (ICR). IDR plans can reduce payments to as little as $0 / month and offer forgiveness after 20 to 25 years of qualifying payments. Borrowers may also qualify for Public Service Loan Forgiveness (PSLF) after 10 years of work in eligible government or nonprofit positions, provided certain criteria are met. Private loans typically do not offer these options and may require immediate repayment or higher monthly obligations. 7. Forbearance, deferment, and delinquency. Borrowers facing financial hardship can apply for forbearance or deferment, which temporarily pause payments. Federal deferment may stop interest accrual for subsidized loans, while forbearance allows a pause but interest continues to accrue on all loans. However, overuse of these options can cause loan balances to balloon due to capitalized interest. Failure to make payments can lead to delinquency, and if left unresolved, loans may enter default after 270 days of non-payment. Defaulting has severe consequences, including wage garnishment, tax refund seizure, damaged credit, and ineligibility for future federal aid. Fortunately, there are rehabilitation and consolidation programs to help bring loans out of default. 8. The student loan crisis and economic impact. The student loan debt crisis has broad economic implications. Many borrowers are unable to buy homes, start families, or build savings due to the burden of monthly loan payments. Studies have shown that millennials and Gen Z are postponing major life decisions because of debt. Some economists argue that the crisis contributes to wealth inequality, particularly among minorities and first-generation college students who tend to borrow more and default at higher rates. Additionally, the growing cost of repayment has become a barrier to upward mobility, particularly for those who didn't complete their degrees or graduated into low-paying fields. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.